Welcome back to Hilaal Live. Now, the Reserve Bank has kept the door wide open for interest rate hikes in the coming months, even as its Monetary Policy Committee left borrowing costs unchanged at their highest level in more than a decade after a prolonged tightening cycle that began towards the end of 2021. Governor Lesetja Kganyago said sticky inflation in major economies suggests average interest rates will remain high, resulting in tighter global financial conditions, which often lead to the increase in the risk profile of economies needing foreign capital. Joining us now to discuss this is economist from Rand Merchant Bank, Isa Mhlanga. Mr. Mhlanga, good evening and thank you so much for joining us here on Hilaal Live.
Good evening, and it's a pleasure to join you.
No, the pleasure is ours. Mr. Mhlanga, I want to talk about, obviously, yesterday's just the keeping of the repo rates. Many consumers were having their hands in their mouth, assuming that there could have been that potential of the 25 basis points. But when looking at it, over the last few weeks with reduced stages of load shedding, with the rand slightly, and I use the word slightly very loosely, slightly gaining some ground against the dollar, it was expected, wasn't it?
Look, the market was split essentially 50-50. If you look at expectations, some were expecting a 25 basis point hike, some were expecting, a no hike. So it was really that even. Even the MPC itself was nearly, split in half. 3 members of the MPC preferred a hold, and then 2 members of the MPC preferred a 25 basis point hike. So, a reflection of what market expectation has been. But if you just look in terms of the reasons behind, it is what you mentioned in your opening, lines to say we have seen some improvement in the currency. Remember, at the time of the May MPC, the currency have weakened quite significantly because of the diplomatic fallout between the South African government and the US government. But we have since seen that diplomatic fallout fizzle out from being reflected in markets, particularly the rand, but also saw bond prices improving, which then meant that the conditions that inspired the 50 basis point hike in May were no longer there. Nonetheless, the risks for inflation going forward remain. Food price inflation in particular, given that we are approaching an El Nino season where we'll receive below average rainfalls. And if you look historically, we have tended to see maize harvests decline by 50% and leading to higher food price inflation, which pushes headline inflation higher. That's a risk. It's not something that we can focus for sure, but it is a risk that the SARB has highlighted. But also, if you look from a global perspective, some of the reasons that pushed the SARB to hike previously are no longer there. The US Fed is expected to be close to peak, but also if you look in terms of the US economy, no longer expected to be in recession, but to achieve what is called a soft landing, essentially, still positive growth with inflation that is declining. That is generally, bad for the US dollar, which implies that the US dollar depreciates, and as a result, emerging market currencies, including the rand, will gain some momentum. And that helps us from reducing those important costs into our inflation basket. So that is a positive development which have contributed to the SARB's somewhat changed assessment of inflation profile. And they did reduce their inflation forecast from 6.2% previously for 2023 to 6%, and dipping well within the target in 2024 and 2025.
Mr. Mhlanga, let's stick with a little bit of positivity and try and paint that positive picture. So, Lesetja Kganyago is saying that, look, interest rate hikes could happen in the future. What would need to happen from now up until the next announcement for there either to be it staying where it is right now, or if by some huge miracle, a little bit of a drop?
Look, in all likelihood, we are not going to get any cuts in interest rates this year. That's a story of 2024. But if we see the assumptions the SARB have remaining the same or unchanged until the September MPC, it means we are unlikely to see any further change in interest rates. But if we see some of the risks the SARB have highlighted, food price inflation, for instance, the currency, oil prices lifting, If we see those risks materializing, then it means the SARB is likely to change the stance and hike another 50 basis point. But that's on the basis of an assessment of risks, not that is not what is expected currently. So we have to see all those risks materialize significantly so that they change the inflation profile of the SARB on the upside direction. And indeed, they did assess the risks to inflation to be on the upside, particularly coming from those factors. So those are the factors that needs to change. The currency must weaken, significantly so, and it must weaken in a way that the SARB sees it as a sustained weakness, not just a once-off like we saw in May. Secondly, oil prices must increase beyond where they have forecasted it and much more on a sustained basis. And then thirdly, inflation expectations must continue to drift higher. That will also result in the SARB changing their policy outlook into a hike.
Mr. Mhlanga, I want to move to external factors, and that being obviously the overseas markets. You've mentioned, and of course, the US not going into a recession or probably avoiding a recession. But there's, of course, the other big economy in the world, and that's China. And there's the instability or the unstableness with regards to the Chinese economy. What would need to happen from an overseas perspective for there to be another push for the interest rate hikes to happen?
So from a global perspective, we'd have to see a shock in oil prices that will push our fuel price higher. But if we're looking purely from a demand perspective, the Chinese economy would have to grow much faster. That normally helps commodity prices across the board, but that also helps our economic growth fundamentals. But what is more important, I think what's more important for markets, for the rand, is what happens to the US economy. Should the US economy go into recession, we will have capital flight out of emerging markets that will drive the currency weaker, and that should be inflationary. But if we don't see the US economy going to recession, then it means we will have a stable rand. Remember, this is something that we call the dollar smile, which is essentially mean when the US economy performs extremely good, strong demand, inflation increases, the US Fed hikes interest rates. That's positive for the US dollar, negative for the rand. On the other extreme, if the US economy goes into a recession, there's a flight to quality, which leads to a strong US dollar and weaker emerging market currencies, including the rand. What we have been talking about since the beginning of this year was the potential of the US economy going into recession. That probability is still there, but there has been a reassessment to say perhaps no longer a recession, but slower growth. It's still an assessment. It's not yet, it's not yet visible in some of the economic statistics, such as US GDP, unemployment rate. They continue to remain quite strong. So that's where the risks lie, whether the US economy goes into recession or not. And if they do, we'll see capital flight and the weakness in the rand that is going to be inflationary, and it will change the monetary policy outlook.
One final question, Mr. Mhlanga. Two words. We've got inflation, which Lesetja Kganyago has said that it's still there and it's still very vulnerable. And then, of course, you've got the 0.4% economic GDP growth. If you are a South African watching, or if you're a South African holding tight onto your money, is there a little bit of an optimistic picture that can be painted for South African consumers, or is the worst still to come?
Look, I think if you just look from an inflation perspective, inflation continues to moderate. It has been moderating for 3 consecutive months for now, and that is positive, particularly for consumers that are on the lower end of the income spectrum, because they find it difficult to adjust to higher prices. So that should be a positive. And as inflation falls, real disposable income improves, which means the purchasing power of the money people have can buy a little bit more than when inflation is high. So that's a positive. But as far as growth is concerned, 0.4% growth is very low for an economy that has a population growth rate of over, of nearly 2%, which means we need economic growth that is above the population growth for us to have an improvement in the quality of life that people live. So from that perspective, answers lie outside of monetary policy. We have to see an improvement in our energy availability factor, and how sustainable that is going to be. We have to see an improvement in our logistics that hamper the exports of the bulk commodities from the mining sector and agribusinesses that would improve our exports. So we have to also see an improvement in the water infrastructure, which is required to make sure that the manufacturing, mining sector, and agriculture they can operate without hindrance of lack of water. So all of those things are things that can only be fixed over a longer period of time. They cannot be fixed over a short period of time. So we have to see those reforms being implemented quickly enough for us to see economic growth improves, that ultimately is going to improve job creation to help the people that are outside of the job market.
Isam Shlanga, we'd like to say thank you so much for joining us here on Hilaal Live.
Thank you for having me.
It's an absolute pleasure. Isam Shlanga, economist at Rand Merchant Bank. Yes, hold on to your monies tightly, but so much that could happen from now up until the next Monetary Policy Committee announcement that will happen in September. After the break, I'll have your latest in news. Do stay tuned.